Hello, friends. If you are 73 or older, or you inherited an IRA, or you moved money out of a retirement account in 2025, this video is for you. Starting this July, the IRS has everything it needs to compare what you reported on your return against what your custodian already reported separately. 5 retirement account mistakes are about to surface in that matching. One of them can turn a $300,000 inherited IRA into a single-year taxable event. And the IRS does not wait for you to learn the rule. Your custodian files the form, the system matches it, and the burden to catch the mistake falls entirely on you. Hello, friends. Here is what is actually happening. This is not a rumor about a brand new IRS task force showing up in July. It is simpler than that and worse. Your 2025 tax return was due April 15, 2026. Extensions run to October 15, 2026. And separately, your IRA custodian and every retirement plan payer already filed their own copies of what happened in your accounts. The distributions, the contributions, the fair market values. The IRS now has both sets of paperwork. The back half of 2026 is when those two copies get compared. I am covering 5 retirement account mistakes that are most likely to surface in that comparison. And the last one is the only part that helps you fix any of them before the process hardens. Grab a pen. Mark the ones that sound familiar. At least one of these applies to more people than they think, and every single item ends with the form, the deadline, and the exact step. Now, before we go any further, retirement account rules do not stay the same from year to year. The contribution limits change, the income thresholds change, the excise tax correction windows are tied to specific tax years, and nobody from the IRS calls you when a deadline shifts. The people subscribed to this channel find out in time. Subscribe now and let's get into it. I need to address something early because people hear a title like this and immediately sort themselves into one of two camps. The first camp is the comfortable retiree, some savings, maybe a paid-off house, adult children doing fine, and they figure this kind of video is aimed at people in worse shape. The second camp is someone living closer to the edge, counting every dollar from Social Security, and they have learned from long experience that the useful rules are always for someone richer. Both of those assumptions are wrong about at least one item I am covering today, and I will tell you on every single one exactly which group it hits hardest and why. Here is something else. I am going to cover these in order of how the IRS typically sees them, from the simplest mismatch to the most complex. But the last item on the list is the correction lane. It is the only one that tells you what to do if one of the first 4 is already your problem. Stay with me to the end, because the last one is the part that matters if one of these mistakes is already yours. Number 1. Missing your own required minimum distribution. Most people who miss an RMD think the fix is simple. Just take double the next year and it all evens out. That is not how the rule works. The IRS treats a missed required withdrawal as a taxable event you failed to complete, and the penalty starts running on the amount you should have taken but did not. Here is the rule. If you have a traditional IRA, a SEP IRA, a simple IRA, or most employer-sponsored defined contribution plans, required minimum distributions generally begin when you reach age 73. Your very first RMD deadline is April 1st of the year after the year you turn 73. Every RMD after that is due December 31st of each year. And here is the number that matters. If you miss it, the excise tax is 25% of the shortfall. Not 25% of your account, 25% of the amount you were supposed to take out and did not. Now, who does this help? Both groups. If you are on a fixed income, a missed RMD can still happen because the rule is not income tested. It applies to every account owner in the RMD years, regardless of how much or how little is in the account. And if you are the comfortable retiree, the dollar exposure is larger because the balances are bigger. Let me put a number on it. Say the shortfall is $10,000. 25% of $10,000 is $2,500. That is the excise tax. But if you catch it and correct it inside the statutory correction window, which closes at the earlier of a deficiency notice, an assessment, or the last day of the second taxable year after the tax year involved, the rate drops to 10%. 10% of $10,000 is $1,000. Miss a $10,000 required withdrawal, and the penalty starts at $2,500. Fix it inside the correction window, and that drops to $1,000, before the waiver request is even considered. One important note, if you have a Roth IRA and you are the original owner, you are not required to take RMDs during your lifetime. That is a Roth-specific rule. But Roth IRA beneficiaries, people who inherited a Roth, are subject to distribution rules. Do not confuse the two. Here's what to do. Take the missed distribution now, calculate the exact shortfall amount, then file Form 5329 with a waiver explanation attached. You can find the form and the worksheets on the IRS Retirement RMD page, or call the IRS at 1-800-829-1040, or schedule an appointment at your local taxpayer assistance center. Do not wait for a deficiency notice, because the moment one arrives, the correction window may close. That is number one. If that felt like a trap, the next one is the trap that can sit there for years. Number two, the inherited IRA you thought could sit untouched. Here is what people believe. As long as they empty the inherited account eventually, the timing inside those years does not matter. For a lot of beneficiaries, that belief is dangerously wrong. Under current rules, many non-spouse designated beneficiaries must empty an inherited IRA by the end of the 10th year after the original owner's death. That is a hard deadline, and the IRS still distinguishes between different categories of beneficiaries: spouses, eligible designated beneficiaries, minor children, non-individual beneficiaries. So not every inherited IRA follows the same distribution path. Now, this is where I need to be careful with you, because the IRS has said that future final regulations tied to certain 2024 proposed amendments are anticipated to apply no earlier than 6 months after they are published in the Federal Register. Until those regulations are final, the IRS expects taxpayers to use a reasonable, good faith interpretation of the existing rules. There was relief granted for certain missed annual distributions in 2021, 2022, and limited relief in 2024. But do not assume blanket relief exists for 2025 or 2026. Verify beneficiary category, year of death, and whether annual distributions apply before year 10. Who does this help most? The comfortable group. Larger inherited balances make the 10-year problem explosive. A $300,000 inherited IRA left untouched does not disappear quietly. By the end of year 10, that entire $300,000 still has to come out, and if you wait until that final year, the full amount can become a single-year distribution event. That is not a tax bill you want to discover in December. Here is your step. Call the custodian that holds the inherited IRA and get the beneficiary distribution rule in writing. Use these words. I need the distribution rule on this inherited IRA in writing. Year of death, whether I am an eligible designated beneficiary, whether annual RMDs apply before year 10, and the final year the account must be emptied. The IRS beneficiary page and publication 590-B are your reference points, and if annual payouts do apply, the deadline is December 31st of each year. The final emptying deadline is the end of that 10th year. That is number two. Up to this point, this sounds like memory and paperwork. The next one changes that, because sometimes the IRS does not discover the mistake. It receives the second copy automatically. Number three, the 1099-R and Form 8606 mismatch trap. I need you to hear this one carefully, because it changes how you think about everything I have covered so far. The first two items were about things you forgot to do. This one is about something the IRS already has, and the question is whether your return matches it. Here is the misconception. If you forgot to mention a distribution or a Roth conversion on your return, the IRS probably will not notice. That is almost exactly backward. Every custodian and retirement plan payer that sends you a distribution of $10 or more is required to file Form 1099-R with the IRS. They do not ask your permission. They do not wait for your return. The IRS gets its copy on its own schedule. And separately, if you converted money from a traditional SEP or simple IRA to a Roth IRA, or if you have non-deductible basis in a traditional IRA and took a distribution, Form 8606 is the form that tells the IRS which portion of the transaction was already taxed. Without it, the IRS has no way to know that some of that money was your after-tax basis. It all looks taxable. Here is the mechanism. The IRS runs an automated under-reporter program. When income reported on an information return, like a 1099-R, does not appear on your filed return, the system flags it. You then receive a CP 2000 notice that shows your reported amounts, the payer's reported amounts, the proposed changes, and a response form. Your window to respond is 30 days from the notice date, or 60 days if you are outside the United States. This is not a tiny typo. If the payer reported $25,000 and your return did not, the IRS sees a $25,000 mismatch. And if you forgot Form 8606, you can make your own after-tax money look taxable. Say $15,000 of that $25,000 was basis from old non-deductible contributions. Without the 8606, that $15,000 is misread as income you owe tax on. Who does this hit? Both groups. The comfortable retiree is more likely to have Roth conversions and basis complexity, but the fixed income viewer can trip a CP 2000 notice with a single unreported 1099-R. Here is where it gets real. Someone in the comments asked about a conversion exactly like this. Dennis, 69, Mesa, Arizona, retired aerospace mechanic. He converted $40,000 from a traditional IRA to a Roth in 2025. He had $15,000 of after-tax basis from old non-deductible contributions, and he filed his return without Form 8606. Without that form, the IRS sees $40,000 of taxable conversion income. With the form, $15,000 of that was already taxed money. The fix: file Form 1040-X with a completed Form 8606 before the mismatch letter arrives. That one amended return protects $15,000 from being treated as taxable when it should be basis. The penalties for missing Form 8606 on their own are not enormous: $50 for failure to file, $100 for overstating non-deductible contributions, both waivable for reasonable cause. But those small penalties are not the real cost. The real cost is letting the IRS treat your own after-tax money as income because nobody told the system otherwise. Here's your action step. Pull every 1099-R you received for 2025. Pull every prior Form 8606 you have filed. Compare them to your filed return. If a conversion or a basis item was omitted, file Form 1040-X now. If a CP 2000 has already arrived, respond within 30 days using the response form or the IRS document upload tool. The exact words to use: I need to correct a retirement account reporting issue involving Form 1099-R and Form 8606 for tax year 2025. That is number 3. And now the part almost nobody sees coming. You can trigger the same kind of trouble by putting the money in wrong, not just taking it out wrong. Number 4. The excess Roth IRA contribution that becomes illegal after your income comes in. Here is what people believe. I made the contribution in good faith early in the year, so if my income later came in higher than expected, it is not a real tax problem. It is a real tax problem, and it is one that costs you money every single year you ignore it. For tax year 2025, the IRA contribution limit is $7,000, or $8,000 if you are age 50 or older. But Roth IRAs have income phase-outs. For 2025, if you are single or head of household, the Roth phase-out range is $150,000 to $165,000. Married filing jointly, it is $236,000 to $246,000. Married filing separately, $0 to $10,000. If your modified adjusted gross income lands above those ranges, part or all of your Roth contribution is excess, and the IRS does not care that the contribution was legal on the day the money left your checking account. What matters is your full year income. The penalty? 6% of the excess amount, assessed every year the excess remains in the account. Not once, every year. An $8,000 Roth contribution that your income made illegal is not a one-time mistake. It is a $480 tax every single year it sits there. Leave that same excess in place for 5 years, and you are looking at $2,400 on money you thought you were saving tax-free. Now, who does this help most? The comfortable group. Income phase-outs are the entire mechanism here. This is the item that surprises the retiree who assumed benefit videos are never about them. A property sale, a pension spike, a one-year consulting contract. Any of those can push income above the Roth line for a single year. And that single year is all it takes. Here is where it gets personal. A woman I heard from in Western Pennsylvania ran into exactly this after a one-year income spike. Carol, 67, outside Pittsburgh, retired nurse's aide. She put $8,000 into a Roth for 2025. Then a property sale pushed her modified adjusted gross income above the Roth phase-out range. Suddenly, the full $8,000 was excess. The fix: Tell the custodian to process a return of excess Roth IRA contribution for tax year 2025, plus the net income attributable to that excess. If she filed a valid extension, the deadline is October 15th, 2026. If she did not file an extension, the standard deadline of April 15th, 2026 has already passed, and the 6% excise tax for 2025 applies. Carol's action saved her $480 for the first year, and $480 for every additional year that money would have stayed. Here is your step. Call your IRA custodian's correction or distribution desk. Use these exact words. I need a return of excess Roth IRA contribution for tax year 2025, plus the net income attributable to that excess. Then file Form 5329 if the excise tax applies for any year you did not correct in time. And one forward-looking note. If you are contributing now for 2026, the numbers have changed. The 2026 IRA contribution limit is $7,500 or $8,600 if you are 50 or older. The 2026 Roth phase-out is $153,000 to $168,000 for single filers and $242,000 to $252,000 for joint filers. Recheck before you contribute. That is number 4. And now the most useful part of the whole video, because if any of these sounded familiar, hoping the IRS never writes is not a strategy. Number 5. The real self-correction lane before the notice hardens. Here is the misconception I hear most often. There is probably some general IRS amnesty program for IRA mistakes. Someplace you can go and say, I got it wrong, fix it for me. There is not. Not for individual IRA owners. The program people sometimes hear about, it is called EPCRS, the Employee Plans Compliance Resolution System, and the voluntary correction piece uses Form 14568. That is for retirement plan sponsors. Employers, plan administrators. It is not a program marketed to the person who missed an RMD or forgot a Form 8606. Nobody is coming to fix this for you. That is the anti-automaticity truth of the entire video. The custodian does not fix a missed RMD on your behalf. The IRS does not file your correction forms. If you want the reduced rate, the waiver, or the clean amended return, you file it yourself, and timing is everything. Here is what actually exists. If you missed an RMD, you file Form 5329, attach a waiver explanation, and take the missed distribution. If you catch it inside the correction window, which closes at the earlier of a deficiency notice, an assessment, or the last day of the second taxable year after the tax year involved, you preserve the 10% rate instead of the 25% rate. On a $10,000 shortfall, that is a $1,500 difference. Waiting can cost you another $1,500 on a $10,000 shortfall, even before you get into interest, notice cycles, or the stress of proving the mistake. If you need to correct a reporting issue, a missing 1099-R, an omitted Form 8606, an excess contribution, the tool is Form 1040-X, the amended return. The refund window on an amended return is generally 3 years after filing or 2 years after payment, whichever is later. Miss that window, and the correction still matters for accuracy, but the refund opportunity is gone. If a CP2000 notice has already arrived, you respond within 30 days. You can use the response form that came with the notice or upload documents through the IRS Document Upload tool. The Document Upload tool can accept supporting documents for a notice, but it cannot be used to file a tax return. Do not confuse the two. Who does this help? Both groups. Every viewer who recognized themselves in any of the first 4 items needs this one. The comfortable retiree with a basis problem needs the amended return. The fixed income retiree who missed an RMD needs Form 5329 and the correction window. The path is different, but the principle is identical. Act before the process hardens. Here is your step. If no notice has arrived, file Form 1040-X and Form 5329 as needed. Do not wait. If a notice has arrived, respond through the notice workflow and the document upload tool. The IRS General Helpline is 1-800-829-1040. The local Taxpayer Assistance Center appointment line is 1-844-455-640. The exact words to use. I am correcting a retirement account reporting problem before collection action starts. Do I need Form 1040-X, Form 5329, or both? That is number 5. So here is the full picture. Number 1. The missed required withdrawal that turns a forgotten year into a 25% penalty problem. Take the distribution, file Form 5329, stay inside the correction window. Number 2. The inherited IRA that still has to be emptied on time even if it sat quietly for years. Call the custodian, get the beneficiary rule in writing, know your 10th year deadline. Number 3. The 1099-R and Form 8606 mismatch that lets the IRS compare your copy to the payer's copy. Pull every 1099-R, compare to your return, amend before the CP 2000 arrives. Number 4. The Roth contribution that becomes illegal after your full year income is known. Request the return of excess plus earnings and recheck the limits if you are contributing this year. Number 5. The correction lane that exists only if you use the right form before the process hardens. Form 5329, Form 1040-X, and the 30-day CP 2000 response window. 5 retirement account mistakes. 5 sets of forms, deadlines, and steps, and not one of them fixes itself. The custodian does not fix a missed RMD for you. The inherited IRA does not explain its beneficiary category to you. The 1099-R does not force itself onto your tax return. The Roth excess does not disappear because you meant well. The IRS does not file the correction form for you. Being legally required to do something and being clearly told how to do it are two completely different things. The gap between them is information. Before you go, I want you to think of one person: an older sibling, a widowed neighbor, an adult child who inherited an IRA and thinks leaving it alone is the safest move. Send them this video, not because they are careless, but because retirement account mistakes are invisible until the paperwork is matched. And by then, the clock is already running. Subscribe. Share this with someone you know who has a retirement account and a tax return they are not completely sure about, and I'll see you in the next one.